We're here with the team from Prerequisite Capital Management, Daniel and Darren, and we're going to have a discussion for a few minutes about bonds and what they look like, and to gain a more deeper understanding of firstly what they are and how Prerequisite Capital Management use and invest in them. So firstly, what is a bond, Darren?
So Josh, a bond is an investment that represents a loan. There are many different issuers of bonds. So an investor would typically invest some capital with a bond issuer who agrees in turn to pay an interest rate or a yield, or sometimes referred to as a coupon, and agrees to repay that principal at a given future point in time. Bonds have a lot of different terms. So a bond can be for a very short period of time, right through to 10, 20, 30 years, and overseas sometimes even much longer. The important thing to remember when considering investing in bonds is that they can and do trade on world major exchanges like a share. So they do fluctuate in value, and we can buy and sell.
But they differ from a share.
Exactly, yes. So they're different in the sense that this is a loan to an issuer of the bond. We're not purchasing part of the company, as in a security or a stock.
So what is the security for a bond?
The security is the certificate that is issued when a bond issuer accepts the funds. They agree to certain terms to pay a certain yield and to repay the initial amount of principal at a given future point in time.
Right. So when it comes to buying, do you buy a bond? Is that the term you use? Or?
Yes, an investor would purchase a bond from a bond issuer.
Right. So you've said that bonds differ from buying a share. How risky are bonds?
Different bonds have different risk characteristics. Typically, a bond trading at a higher yield will have greater risk associated with it compared to a bond trading at a lower yield.
Right.
In the overall risk profile of most conservative to most aggressive bond investments, your federal government bonds are generally seen as the most risk adverse simply because of their ability to tax, and if they ever get into trouble, they can increase taxes to ultimately repay those bonds or the coupons on those bonds. Whereas if we're considering lending money to a corporate or a company, different companies have different balance sheets and income position and expense positions, so they typically will trade at a higher yield.
Explain to me for a minute yield. You've mentioned that term a few times when it comes to bonds.
The yield is essentially the interest rate that is paid or associated with a particular bond. Right. Interest rates or yields will be lower for the more secure, because you're confident of getting your capital back definitively and on time. A more riskier type investments will typically pay a higher yield.
So Daniel, when we buy and sell bonds, I guess what determines the yield price?
Yeah, bonds are traded or bought and sold on a secondary exchange in terms of price.
Right.
Right. So prices will go up and down, but all price is an embedded yield. So if we've made a loan for 30 years, the value of those cash flow repayments, so the coupons that are repaid and then the principal at the end that's repaid, discounted back to the present, is going to be discounted back at a certain implied yield.
Right.
Right. Now, if you just held that 30-year bond to the end of the 30 years, you're going to get that yield return per annum is effectively the rate of return. If
That's
you're gonna,
right.
if you get it, if you hold it all the way to the end date of the bond when they repay the capital.
So, for example, if it's 2% per annum yield,
yes.
Over 30 years, you're just going to get 2%.
If you held it to maturity, that'll be ultimately the return you're going to get per annum and your original principal back.
But that differs from price.
Yeah, so when a bond is initially issued, they basically go out to the marketplace, say, hey, we want to issue a bunch of bonds, or basically we want to borrow some money, right? Investors will come along and go, okay, how much do you want? And they'll figure out a yield. And so they'll lend, say, the US government for 30 years a certain amount of money at a certain implied yield, right? Whatever they issue it at. Now that primary issuance will give that investor a certificate saying that, hey, the US government owes me a bunch of money in 30 years' time.
That's right.
Whatever rate. Now, me as the investor, I can either put that in the bottom drawer and hold it for 30 years and get whatever I lent them back with the coupon payments over that time frame, or I can then take this certificate that says the US government owes me whatever in 30 years' time with these coupon payments along the way, and I can go to a secondary market and trade that with other people.
Right.
So I can sell that certificate to someone else who wants to take over that exposure from me.
Right,
You know,
right.
so I get effectively my money back, and I can sell that, and they take over the loan to the government. And so the secondary market, we buy and sell these certificates or bonds. Same works if it was Apple or some other company that issued the bond. You know, there's the primary issuance and then the secondary market trading of whatever that security is or that bond. When we're buying and selling bonds, normally it's quoted in yield terms, but the price, but depending on what we're talking about, people think of it in terms of the implied yield, because that's what you're going to get if you hold to maturity.
Yes.
But price is actually the inverse of that yield. So if we issued, if we bought a government bond and it was yielding 3%, that means that all of the future cash flows discounted back to present are currently valued at that by that bond market at a 3% implied yield or discounted yield. Now, if that yield drops to 2% for some reason, that means we have a bond that we bought at a 3% yield, but all of a sudden the general environment is that the marketplace is now 2% yield. So this piece of paper is worth more effectively.
Right, right.
And so the price adjusts. And so yield and price work inversely to each other, right? So the price of a bond is just all those future cash flows discounted back at a present yield, right? So people will talk usually in terms of yield when it comes to bonds or the bond market, but the price depends on how long it's for. You know, so if there's a big difference between a 30-year bond and a 10-year bond in its impact in price. A 30-year bond has the price is more sensitive to any movement in yield, right? Whereas a 2-year bond or bill is highly insensitive to changes in yield.
Yes.
Right. So the longer the duration, the more price is sensitive to any change in yield. So here's an example of a 30-year US government bond. So these are 30-year yields going back to 2004. So around the end of 2018, they were roughly at a yield of about 3%. And that translates to a price of about 45 roughly. And so yields dropped from about 3.5% to about 1.5% post 2018. Right, so the value of the bond went up. Now this increase in price is from about $40 to about $75, which is a pretty significant
big return
gain in price for, you know, a 1.5–2% drop in yield. Right now, the reverse can happen. If the yield rises, the price or the value of the bond falls in that secondary traded market. Okay. And so when we put a bond into a portfolio, right, there's certain things that cause yields to move up and down, like credit risk and a few other things that we'll get into. That causes prices to fluctuate up and down. Different environments will cause yields to move in different ways, and so, but the price of the bond will kind of act as a ballast in the portfolio.
Of course,
prices will go up when yields fall and vice versa. And so that's basically the short version of, you know, what is a bond and how do prices and yields work.
So just clarifying a couple of things. Once that bond is issued, it's set at that rate of return for the length of that bond, whether it's a 10 or 30 year. So there is this yield that every bond, I guess, has
Is
built into
effectively
it.
bought out. Yeah. So
Yeah.
when I purchased that initial bond, or
Yes.
the loan to the government will specify that, say $1,000 is the principal,
Yes.
and there'll be coupon payments every 6 months of whatever, say 3% per annum forever. But I will pay the government an amount that basically at the appropriate yield.
So what makes
as
that
distinct
yield
from
move?
coupon?
Because they move at different values throughout the course of, obviously we're looking at this.
There's two major drivers
Right.
of yields. First being inflation or inflation expectations. So as inflation expectations rise, that pushes yields up. As inflation expectations fall, that pushes yields down. The other major driver to yields or major consideration is the credit risk. So who are you lending the money to, and what is the strength of their balance sheet and income and expense position? They're the two major determinants of yield.
Which makes sense, because as inflation's rising, that kind of means that the money you're going to get back in the future is going to be worth less.
That's right, yeah.
Right? So I demand a higher yield for that to compensate for me for that risk of the money being worth less in the future.
That's right, yeah.
But works on the flip side. In deflation, right, that means the money in the future is actually going to be worth more.
Huh.
So the yield falls. So, and that's and the same with credit risk. If the prospects for a company or the government are improving, right, that means credit risk is decreasing. That means the yield I'm going to demand is also going to decrease, right? If all of a sudden the prospects for a company or the government or whatever in the future are becoming more risky, and so the likelihood of repayment is becoming more uncertain, I'm going to demand a higher yield to compensate me for that.
Yeah.
So the price of the bond will actually go down, right? So, and vice versa, if the prospects for some given company or even the government improve, right, because economic growth is expected to do a lot better, the prospects of a given company, they're going to become more profitable because of some new product line or competitive landscape change, whatever. But all of a sudden, the prospects, the risk of not getting repaid go down.
Yeah.
So the credit risk decreases because future expectations are improving, better confidence, all of this. So the yield goes down and those bonds become more valuable.
Yeah, great.
Yeah. So markets are always changing and adapting. So we have clients who have grown up in Brazil or Iraq or many different parts of the world, and they understand credit risk to a very high degree.
Of course, yeah.
So a government bond is essentially seen as the most risk adverse.
Yeah.
But there are situations and different types of events that can see government bonds become very risky. So it's not something that we can set and forget. It's something that needs to be monitored on an ongoing basis.
Of course.
Yeah, and as with everything, it's the same with an individual as with a government and a nation or even a company, right? So certain individuals are more reliable, more diligent, more highly skilled, more likely to be able to repay, right? Or more trustworthy, because all the bond is a promise to repay.
Right.
It's trust, and it's the same with governments. There's different governments are somewhat more credible, more grounded in a reliable rule of law, which means the predictability is much more likely that they're going to repay or meet their promises to
Yes.
repay, and not repay you in inflated away currency or whatever. And so all of these metrics sort of feed into that credit risk assessment. And it's exactly the same dynamics that are kind of happening when a bank lends a person some money to go and buy a house. The bank is effectively buying a bond issued by the person who's borrowing the money,
Yeah.
right? And the bank wears the risk of them not repaying. And so they'll charge a different interest rate or a different yield, or even that loan that has been made to that person to go buy the house, the mortgage. The bank might then sell it elsewhere.
Yes.
Sell that loan to another party on a secondary market, who will then get the repayment from that person, in that mortgage. So it's all the same sort of basic principles, same idea. And generally speaking, you can look around the world, and even with governments, to the degree that a government basically subordinates itself to a higher law kind of principle, so valuing life and doing all it's agreed to do and not harming people arbitrarily and all of this sort of stuff. So a higher law set of principles that are enshrined, to the degree that a government subordinates and serves the law, is generally,
That's the same with individuals, right?
well, yes, to the degree an individual
Yeah.
actually subordinates themselves to a higher set of principles
Yeah.
that values people, values their word.
Yeah.
Their word means something.
Yeah.
A promise means something. They'll keep their word to their own detriment, etc., etc. Obviously, that's less credit risk. That sort of a person, especially if they also are diligent and have skills to be able to earn an income to repay. Same with governments.
Yeah.
And also the reverse applies. If the legal system and the laws serve government agenda, so government doesn't serve the law, in fact the laws serve the government and agenda, then that legal system and those laws are going to be more arbitrary.
Wow.
They're not as reliable, not as predictable. They change the law to suit whatever their circumstances and agendas are at any given point in time. Higher risk, right? Same with a person. If a person only adheres to a higher set of ideals or honesty or principles or whatever, when it suits them,
This whole
that's a
discussion.
risky dynamic, right? And so it's all the same principles, whether it's an individual or a government or a company or whatever.
Yeah. Wow.
And because you're trusting the government as well, not to just go and print money to cause a ridiculous degree of inflation, so the future money that comes back is devalued.
Yeah, that's right.
And so all of these things factor into yield, right? Or the
Yeah.
yield on a given bond or debt security.
There you go. Goes, adds a whole nother light on that phrase. Your word is your bond.
Yes, exactly.
Yeah.
That's right.
Yeah, great. So we've just had a discussion about what bonds are and how price and also yield interact. How do you, as prerequisite capital management, analyse bonds and understand them and interact with them?
Yeah, so in using bonds within a portfolio, we kind of obviously need to get a deeper understanding of what really makes yields move, what the likely prospects are, how do we build that in and interact within a portfolio, especially to meet the specific objectives and profile of performance that we're targeting.
Yeah.
So when it comes to bonds, obviously we just talked about how inflation and credit risk, kind of two of the main overall drivers of a bond yield. Now, mostly when we use bonds, we tend to be focused a little bit more towards government issued bonds, right? And not just any government, usually developed world governments,
Right.
Like Australia or the US, that have a reasonably solid pedigree with regards to rule of law, predictable property rights. The reason being is our mandates are reasonably conservative. We don't really want to take excess risk past a point when we're trying to, meet our our return objectives. And when we use bonds, we are usually trying to protect ourselves against deflation risks.
Right.
Okay, so the risk that we get a shock in the private system or in this over-indebted environment that is deflationary in nature, that would cause bonds to fall, or bond yields to fall, price to rise, to offset any other sort of risks or falls in asset prices elsewhere in our portfolio.
Right.
Because normally a deflationary shock where there's some sort of a crisis or some sort of negative conditions that causes a scramble for cash and collateral, and a loss of confidence temporarily or maybe a bit longer in the broader economic environment causes people to kind of hoard or de-risk.
That's right, yeah.
Right, and that de-risking, hoarding response stops the circulation of money in an economy. People don't want to spend money or take risk or invest into things. They just want to protect themselves. And that tends to be, at least if it's a non-government sector induced shock or crisis, throughout history that tends to be a little bit more deflationary in nature. Because normally credit is defaulting, or assets are becoming impaired, or unemployment's going up, incomes are becoming uncertain, and so cash is king in that sort of environment. The value of cash is becoming more valuable.
That's right, yeah.
Which is deflation, right? And so the value of any future promises to repay becomes more valuable if those future promises don't have too much credit risk attached to them, which is where government bonds kind of come in, because mostly there's a greater confidence that a government can repay than a corporate, you know, or a company.
Yes, of course.
Because, past the point, the government can send people with guns to come and take your property or your assets, or to enforce repayment.
Of course, yeah.
Companies can't do that, fortunately. And so we tend to use government bonds as a deflation hedge, so to speak, or a banking system shock risk hedge. If the crisis or the problem is actually in the public sector, in a government-initiated type crisis or issue, or at least as a general rule of thumb throughout history, then those problems tend to be inflationary in nature.
Right.
Right. So private sector is an oversimplification. Shocks and crises that occur in a private sector type origination tend to be a little bit more deflationary in nature. Public sector or government-induced shocks or crises,
so
past the point, tend to be a little bit more inflationary in nature.
So can you give me an example of a private sector versus a public sector shock?
Yeah, so presently, like even if we go back to 2008, that was more private sector induced. So the economic system kind of got way ahead of itself, too much debt, too many unsustainable businesses and investment structures, debt that couldn't really be repaid, and also a lot of mispriced debt. There was a lot of complacency.
That's right, yeah.
And so basically recessions and crises and different things tend to happen when a system gets too complacent or misjudges risk, or the calculation of risks in an activity or an enterprise or in the broader system. And then basically it goes, wow, actually we've totally miscalculated or misjudged all of these risks. So if I'm running a business, I might have loaded up the garage, the factory full of inventory of particular products, which I think there's going to be sustainable demand for. And I get way ahead of myself, get complacent about anything. I think, these products are fantastic, they're going to sell till the cows come home. And so I load up the factory full of inventory, but then something happens to make people more cautious and less willing to spend or buy these products. And then they realize, oh wow, we've misjudged circumstances and business activity and demand. We've got too much inventory now, we need to dump that, or we're in trouble, or so they just can't sell it and they've spent all this money, they move into significant losses, et cetera, et cetera. And so that's kind of that misjudging of dynamics or risks or pricing or conditions tends to snowball into, say, a recession or a retrenchment in business activity more global.
So talk broadly to me about how that works at a government level.
Yeah, so just to back up, just before we get into that, if there's a lot of debt in the system, so if this economic cycle has grown or expanded and businesses have taken on a lot of debt to, say, get that inventory or to invest in new things or to open up new markets or whatever, or consumers have borrowed too much money to go and buy houses or go on vacations or whatever, there's too much underproductive or unproductive debt in the system as well. That then exacerbates any sort of retrenchment in activity. Debt works, it's a double-edged sword. It works great if it's in broadly good conditions and it amplifies to the upside any profits or any gains. but it also cuts both ways. And so if conditions turn to be less confident, more fearful, more negative, less activity, then that debt amplifies losses, downside. And so when there's too much debt in a system, which tends to happen in the private sector, especially if it's combined with complacency or misjudging risks in the broader environments, maybe trade relationships with different countries change, and that upsets the economic balance in things. And then that cascades through to less demand in certain sectors than what was anticipated.
Right.
And if there's debt involved as well, which usually is the case in non-government private sector issues, then any issues threaten the repayment of that debt. Right? So there's a debt default risk comes in also, right? And so across the board, money becomes more valuable because everyone wants money to pay debt or protect themselves or meet their obligations. And there's less confidence out there, less activity, less willingness to invest or buy things or whatever. And so that causes that deflationary sort of impulse where cash becomes king. Cash is key to survival, key to be able to still operate. Cash is becoming increasingly scarce out there because people are hoarding it rather than handing it over and transacting or investing or whatever. So cash becomes king, deflationary impulse comes, especially if there's debt defaults or asset impairment or bankruptcies start to hit, because the conditions, they can tend to snowball. Right. Whereas if it's a government-sourced problem, normally by the time you get into issues of government-sourced problems, they've already kind of effectively run down the economy a fair bit. So that capacity to produce goods and services, standards of living are already being pressured by the time you get to this point. They've probably borrowed too much money to fund whatever their programs are, or wars, or whatever has caused them to get into a fiscally or a budgetarily dangerous position. Right, and so then they're incentivized usually to print money to fill that gap that they can't tax, or the population won't tolerate a tax. So they'll tax them indirectly by just printing money to meet their obligations or to spend or to whatever. And so generally speaking, as a general rule of thumb, throughout history, private sector issues, while the government's still intact and there's a solid rule of law and whatever, tend to be deflationary in nature. It's an oversimplification, but it tends to hold most of the time. Governments getting themselves into trouble. Normally the private sector's already hemorrhaging anyway by the time the government's got to that point. And so governments get into trouble, or there's a crisis hits, then it tends to actually be inflationary as a general rule of thumb. When deflation occurs, it usually means credit structures are being written off or they're contracting, and so the amount of money in the economy is actually shrinking, not expanding.
You made a statement that governments tend to tax them indirectly by printing money. What do you mean by that?
If the government has promised too much, right, either benefits, or if they're spending too much because they're trying to fund a war or a welfare system that's gotten out of hand, or a medical system or whatever, if their spending is outpacing what they're collecting in tax, and probably, if we're talking problematic government environments, they've already taxed that private sector heavily. A lot, and so either they can't, they can increase taxes, they just, further pressure that private system, and it just can't pay more taxes. Or there's no political will because the powers that be will get turfed out.
That's right.
So they don't want to tax directly, so they'll indirectly they have the sovereign ability to print money, to create money from nothing. Either just literally printing it and handing out cash, or using that cash to pursue their agendas.
So does the value of that money then drop?
Especially the government's just printing it and creating it out of thin air. It's not backed or associated with productive output. Right, because money actually can get created, this is a broader subject, but money actually gets created en masse in the private sector when productive output expands and when credit is given and that market mechanisms are in place and contract law makes sense and is predictable and reliable and all of this and fair, and so money actually is created in most part out in the private system. And if it's created on the back of productive output, useful goods and services and stuff,
There's a
then-
value behind it.
Yeah, there's a value behind it.
Right.
But if the government is creating it just by fiat, by decree, by just saying print more money and they just create it out of nothing, it's not backed by useful
Of
goods and
course.
services. It doesn't have the same inherent value to money created in the
Right.
private system. And so if the government create too much money by decree that isn't backed by useful goods and services and productive activities and enterprise and output, then that they can direct it to wherever they want. That will cause a redirection of goods and services and resources away from productive output to unproductive output, because the government's kind of forcing that.
Right.
And they're creating purchasing power out of nothing.
Huh.
And so that then pressures productive output in that private system to be constrained, or at worst actually start to collapse.
Huh.
And living standards collapse. And that inflationary dynamic sort of takes off,
Takes
or,
off.
or
Yeah, yeah.
gets embedded.
Which makes sense. So we're
And
talking
so
about
crisis in that condition would be more inflationary, because everyone will
Right.
freak out, go, oh, well, the private sector is getting pressured, the government sector is going to, reasonably be expected to lean into that heavier, and so inflation expectations go up, right?
Yeah.
And so a government-driven, problematic government environment, inflationary in nature by definition, problematic private sector environment, a deflationary bias to crises, because it's debt contraction, money contraction. Money's actually being destroyed because money is created on the other side of credit being lent or
That's right.
created.
Yeah.
So if credit all of a sudden becomes revealed to be not repayable, then it needs to be written off. It's almost like a destruction mechanism for shrinking the pool of money. So the deflation, or the value of money, increases.
Wow.
And so the value of if you've got no credit risk in an issuing entity in deflation, then that yield will fall.
Right.
Right. And so
Right,
that's where,
right.
if it's a private sector issue or crisis or miscalculation, and it's a deflationary bias to that issue, the value of future money becomes more, because presently we're seeing that contraction.
That's right. Yeah. Yeah.
And so if you've got a loan to the US government or some federal government that's reliable, that has room to move to repay, that becomes more valuable. So the
Yes.
yield falls, the price goes up, and the value of our bond increases if we were to value it or sell it to someone in the secondary market.
And so that kind of gives us some context of the way you understand and think about
Yes, I mean,
bonds,
yep.
which is what we really want to, I guess, dig into.
So yeah, we've actually covered more territory than I thought we would cover in that. But when we actually start to think about analysing bonds and prospective returns and environments, and how we then counterbalance that in the rest of the portfolio, like I say, every asset class tends to map to three factors: so growth, inflation, and capital flows. So if conditions are improving in the economy, generally speaking, yields will actually tend to increase, right? Because bonds still have to compete with all the other uses of capital.
Yeah, of course.
Right, and so if profits are increasing in the economy, bonds have to actually price a higher yield to still attract capital, because it's competing with, say, use in a small business or in investing or whatever that have a higher expected rate of return. So generally speaking, increasing growth will cause yields to increase, generally speaking, and vice versa. Decreasing growth or a recession will tend to usually cause yields to decrease, or at least in the current regime, where we're not totally in a problematic government environment just yet in most of the developed world. Now, and then so growth is one thing. Inflation, we've kind of talked about.
Yeah.
Now, that probably is the biggest driver, practically speaking, of especially long-term government yields. And so increased inflation, increased yields, and vice versa. Decreased inflation, decreased yields. Capital flows, basically how much capital is concentrating into that asset class versus others, or one part of the world versus the other. So if capital is concentrating into the US and it's fleeing other areas of the world for whatever reasons, that will tend to make the US a more capital abundant place.
Yeah, that's right.
Right, almost by definition. And if it's they're seeking safety, for example, which often may be the case, then that will tend to cluster into less risky sort of government bond exposure, which pushes yields down and prices up, because capital is concentrating in there. And so the price is rising because there's increased demand. But vice versa, if capital is fleeing the country, odds are those yields are going through the roof because capital flees for a reason.
Yeah, it really does come back to that trust, doesn't it?
Yeah, and the behaviour of people and money and all of this sort of stuff. And so actually flipping back to the growth thing, for example, up to a point, decreased growth can actually flip over to increased credit risk, obviously. So decreased growth in a government bond, provided they're still in a context that's broadly stable, we'll see decreased yields. But if decreased yields get to the point of really upsetting too much of the apple cart, especially from a government perspective, then that can cause an increase in credit risk, right? Because people see actually this growth crisis is even worse than expected, could even impact future ability for government to make good on its promises, and so the credit risk goes up. So there's a lot of moving parts. Like at the beginning of our conversation, we started much more simplistically.
Yeah, absolutely.
And so already now you're starting to see
once
how
you drill
this
down into it, there are...
Yes, and it actually gets even more in depth and more intense than that. And so when we look at analysing government bond yields in particular, obviously there's a slightly different ways of looking at things if it's also you're starting to consider corporate issuers or other sources of bond issuers. So obviously inflation expectations, sovereign credit risk, economic confidence, the demand for collateral in the system. Basically our banking system is backstopped by these government bonds, right? Government bonds actually by regulation, by law, are effectively mandated as zero risk capital, right? So when the banks lend money and do all of their activities, they have to support that on the other side of their balance sheet with capital, basically, or equity. And so bonds are embedded as if they offset their loan or risk exposures over here, and it's backed by, can be deposits or this or that, or they can own a bunch of government bonds as well to sort of backstop, these risk exposures, basically. And so government bonds, when you tie it all back through the system, they are one of the key pillars of collateral. So if things are going wrong, crises are blowing up, or something's becoming unstable, or the environment's becoming more risky, generally speaking, there'll be greater demand for collateral.
Can you just define collateral very quickly for us?
Actually, a good example is a mortgage, right? So if the bank lends someone, some money to go buy a house, they'll take some collateral, some security.
Security, yeah.
If you don't repay, they've got ownership, they take title of your house, and they can take that asset as collateral and sell it, right? Now, typically they will want more collateral put up than what they lend you.
Right.
In the case of, you defaulting or not meeting your promises to repay. And also the value of that asset or collateral can fluctuate as well.
Right,
and so they want a safety buffer there.
So government bonds are a strong...
Yeah, so government bonds kind of work in the financial system in a similar sort of way, where if all of a sudden credit risk, more generally speaking, in the deep plumbing of the financial system starts to become more uncertain and more fearful, or trust, or people are not sure where issues are, or there's risks, unexpected losses start to pop up or whatever. So repayment generally becomes less certain between different financial institutions, or generally speaking, there's a certain amount of cash and collateral being reasonably safe assets, or assets that are worth more than whatever the exposure is, that can be taken and then sold to recoup the whatever is promised to repay.
Yeah.
right? And so the way the current system works, the current currency and banking systems around the world, especially with a US-centric sort of focus as well, government bonds typically focuses that, cash and collateral type backstop that everything else sits upon, and so a lot of lending occurs on the back of using collateral in the show. So in many ways, another definition, or a more sophisticated definition of a bond, especially a government bond, is future currency collateralized. Right, so future currency because you get paid currency in the future, but it's collateralized into an asset effectively that you can buy and sell on a secondary market that represents a claim on those future cash flows.
Yes.
Right, so future currency collateralized. Right, and so if there's uncertainty around the integrity of currency or too much inflation or something and the future currency becomes impaired, that asset's going to be worth less, right? And the yields implicitly will be going up.
Great.
And vice versa. So anyway, so demand for collateral in the system, usually that's more of a banking system and analysis paradigm and banking system in the broadest possible context, but that probably goes beyond this global capital flows we've briefly touched upon. Bond market, underlying liquidity and participant positioning. So in that secondary trading of that security, where you're trying to buy, you can buy and sell a bond, in seconds or minutes. I can go and buy a 10-year government bond and then 5 minutes later sell it again. Right. And so how liquid, how able am I to buy and sell?
Yes.
And also, is that market becoming too unstable? So too many participants have gone too far on a limb. They've even borrowed money to fund it if it's in, or effectively in the derivative markets. And so when participant positioning gets too far out of whack, it's that market's liable for a counter swing just to kind of clean them out and keep the market mechanism functioning. And so analysing all of these things in a deeper, more intense way is basically what we do. Actually, everything we do in our portfolios, we're trying not to predict the future so much. We construct it on the diversification sort of principles and diversifying, especially those three primary factor drivers of growth, inflation, and capital flows. We tend to align with the broader cyclical trends, multi-year trends, and so if the broader trend for yields is up, that means prices falling. We'll tend to own less bonds at the margin, but we'll still own bonds as a diversifying factor. And if for whatever reason the broader multi-year trends are for lower yields or higher bond prices, we'll tend to own more of them.
Right.
Or if we're in an environment that is inherently quite risky, especially from a banking system perspective or an over-indebtedness perspective in the economy or unsustainable debt structures, we'll tend to, at the margin, own a bit more of them, or bonds, because that's like insurance in a sense. And so there's a few different things, but we try to not predict the future. But if we gain deeper insight into the present, that gives rise to a degree of foresight, right? Without trying to predict stuff, you just start to see what potentially is possible or probable is really. And so at the margin, we still do a pretty deep dive set of analysis into all of these factors to be able to get a sense for, well, where are yields at? Where might they move? Where are the conditions? What's happening now? And does that frame future possibilities differently? For example, so in the flows and participant positioning, if I skip ahead a couple of charts, here's the speculative participants. So there's different participants in any market, There's usually the speculators, so they just want to buy high and sell it higher, or sell it high and buy lower to try and make a profit. They don't really care on the broader, what's going on. They're just trying to trade it as an instrument that moves to be able to make money, So, and they potentially will be doing it with leverage. So they'll actually implicitly be effectively borrowing money to take big exposures to gain from an increase or a decrease in price. And so their activity you can kind of track every time they get incredibly washed out. So this is the 10-year US government bond yield, but it's flipped upside down to kind of proxy price.
Yes, yes.
You know, so yields are falling, price is kind of rising.
Yeah, that's right, yeah.
Yields are rising, price is falling. And so you can see the speculative community or participants underneath this market are excessively optimistic, too much so, and that tends to mark a turn or a top type condition. And on the flip side, when they get really pessimistic, they've sold too much, they're very short, or they're actually out of the market altogether, depending on their mandates and what they're doing. But very pessimistic towards bond prices, because they think yields are just going to rise and rise and rise and rise, or prices are going to just fall and fall and fall and fall. For whatever reason, they're too extreme in their activity. And so that makes higher probability turn points or buying opportunities. Right. So if we gain some insight into the present, like this is a real-time example back from 2018 where we were like, hey, the pessimism towards bonds, government bonds, is ridiculous. It's at extremes. And when we went and studied what was in those pricing assumptions, so what is the market collectively assuming about yields that's got them so negative they just don't want to touch bonds with a 10-foot pole? Are those assumptions reasonable? And obviously there's a lot more research that goes into it. The short answer was no, they were quite unreasonable. So insight into the present helped us see that a higher probability for a counter swing, just like the last time it got ridiculously pessimistic. Okay, and then so this is 2018, the end of 2018 roughly, this is basically one of the securities you can buy on a stock exchange actually that represents a basket of US government bonds.
Right.
So you were able to buy it here, you know, which corresponds to this green, this low,
yes.
and that extreme washout in sentiment, so to speak, or speculative activity, and then enjoy that rise, right? And so it wasn't so much predicting the future, but it was analysing how reasonable are these assumptions, especially at this extreme, this historic extreme. You know, so that's an example. And even with inflation expectations, right? So in orange here, going back to 1920, this is for the USA. In orange here is, so there's lots of ways to measure inflation. It gets quite complicated, but let's just oversimplify it and say that the Consumer Price Index, or CPI, is respectively indicative of inflationary trends.
Yep.
This is the annual rate of change going back to 1920, basically up till, I think on this chart, 2018 or present-ish. In the 70s, you know, pretty hyperinflation type conditions, relatively speaking. In the US, this was running at a 15% per annum rate of inflation, is what that kind of means. So there's normal sort of headline measures of inflation. There's also market discounted measures of inflation, right? So the way bonds markets trade and yields and different types of bonds kind of imply certain forward-looking inflation expectations. Right. Now, in blue here, light blue, it's hard to see, but they basically are the market implied inflation expectations. So what, at this point in time, looking forward for 10 years, the bond markets in the US were anticipating 3% inflation for the next 10 years. Is simplistically what it's kind of doing. Because if you can see it and it's out of your head, if conditions change, the data changes, especially in a timely way, you can see the change, and you haven't fallen in love with whatever you think you're perceiving.
Yeah.
Right.
So
if it's an
sense of detachment from the.
Yeah, exactly. So we want to become more objective, and we want to be able to see what is in price or the assumption. So we always try to reduce concepts back to data, right, and a model that we can see. And so this is, we've been able to figure out how to measure inflation expectations using capital market pricing, going back as well. And that also gives us a capacity to have a sense for a leading indicator of inflationary trends, which means we have a leading indicator of yields. Right? Now, no indicator or model is perfect in its own right, but you put a bunch of tools together and they all become useful and almost synergistic It's like leading a team of people. Every individual has strengths and weaknesses individually. A good leader can bring a group of people together and basically cause all their strengths to complement each other and the weaknesses to kind of wash away and create that, some of
The many?
is worth more than the parts.
Yeah.
Right? And that's the mark of a good leader. It's the same when we analyze a bond market or any market. We want a bunch of tools. Individually, each tool might not be fully perfect, has strengths and weaknesses, but is useful, provides us insight and some probabilistic understanding of things. Put all those tools together, it paints a pretty clear picture, and we have greater insight and conviction to act. And so here, you can't really see it because it's too big a time frame, but our leading indicator of inflation was starting to collapse, which was leading even the market measure of it, and definitely leading the more headline generic measures. And so that, combined with flows and a positioning extreme and unreasonable expectations, led to an opportunity here to own a lot of bonds and then benefit, And even though that's a positive example, we don't try to predict things, but you can see situations that occur where the pricing assumptions are just unreasonable, and it's more probable that the opposite or something different will happen than what the pricing in any given market is, which represents opportunity, right? And so at the margin, we'll kind of be happy to own more bonds at that point in time. But, even though probably 60% of the returns probably are driven by diversification principles and just broader multi-year kind of trending type conditions, there's still 40% of returns at the margin are kind of influenced by some of this deeper level analysis.
Right.
And so that's
Having the ability to do that.
yeah, and it's all the ability. It's trying to see into things.
Yeah, that's right. It's the set of tools that you've built as a team.
And so that same thing applies to all of this. Like, people are very not very clear on how to measure sovereign credit risk, for example. So the risk of a government issuer defaulting. How do you measure that in real time? How do you, just like we did inflation expectations, how do you see if it's increasing or decreasing or at an extreme or anything else? Most people can't objectively measure or model that. Whereas, we've spent 15, 20 years trying to figure out how to do just that. Now, our solution isn't necessarily perfect, has strengths and weaknesses, but it's a lot better than what everyone else is using, right? And so it's useful.
Great.
And so we can even measure and map sovereign credit risk in any jurisdiction or on any issuer, right? And in other videos, we'll probably actually go into some examples of that with companies, with whatever. But drilling down on each of those things helps us to better understand where we're currently at in the pricing structure in the bond market, and then what the prospects and risks are.
Great.
So it's just a more informed view of bonds, and then how to use them and how to incorporate them towards different return objectives or portfolio mandates.
You've definitely thought it through. You've definitely got a set of tools at your disposal that I think, I guess, obviously, given the examples you've shown us, have some great returns. So,
yeah, we won't always get it right, but if we can kind of get it right more often than not, within a diversified construct of a portfolio, then we'll more than, we'll definitely achieve the return objectives we're after.
Great. Brilliant. Thanks, Dan.